most important day of your life towards financial freedom. Everything most likely will change in your wealth accumulation, but only if you decide to apply what you learn. Knowledge is only potential power. It's action that creates power. Let me show you the truth that they never taught you in school. You see, money is energy. It's not just paper. It's not just numbers in the bank. It's your time, your skills, your sweat and effort converted into value. Your work is the output. Your energy is what fuels our economy. But here's the problem, that energy, your energy, is being sucked into a system that was never designed to set you free. Let me show you the truth they never taught you in school. Let me show you something that most people never see. This is the black hole of money. It's invisible to most people, but it's everywhere. It pulls your bank account, your income, your energy, your future. And the craziest part is you've been feeding it your whole life. Every time you deposit your paycheck in a bank, every time you put money in a 401k, every time you swipe that credit card, you're sending your energy into this system. A system that was never built to make you wealthy, only to make you compliant. So these are the forces that make up this black hole money. The first one, inflation, quietly eroding your purchasing power. High taxes, taking a chunk before you even see your money. These 401k traps, or these retirement accounts that the IRS is your partner, locking your future behind penalties and Wall Street rules. High interest debt, compounding against you instead of for you. Credit cards, student loans, car payments, a 30-year mortgage. And then there's this consumer mindset, programming you to spend instead of building wealth. It's this silent siphon, a black hole for your wealth. It just gets bigger the more you feed it, and the more you stay inside its gravity. And the more you're in it, the more tired you get, the more frustrated you get, and more stuck you become. And so will your family for generations to come, your children, your grandchildren, because that's all they know. And that's all they've been taught, and that's all they've seen. And so it just keeps getting bigger and bigger, feeding on your work output, your energy. You work harder, but you lose more. Raising prices, crushing taxes, locked up retirement accounts, compounding debt, and a system designed to keep you spending, not building. You can't change this. I mean, it's been around older than any of us. But what if there was a way for you to use it to your advantage, make it work for you? And that's what we're going to talk about today. And yes, you can change the system, but if there was a way to make it work for you, would you use that? What if there was a way to flip the script? What if you could reclaim that energy and redirect it to building true, tax-free, compounding wealth? And what if you can escape this black hole starting today? And what if it's not as hard as you think? And starting today, if you can just own your future, building true wealth. So how does this work? Well, first of all, you have to understand the forces that control it. The IRS controls the taxes. The banks control the money printing, or the Federal Reserve. And Wall Street controls the stock market. If you can use how the system designed to work for you, since the wealthy are using it, you can use it too. And this is the infinity wealth system, where you can build wealth like the 1%. The banks in Wall Street and use the IRS rules to work in your favor. They don't play by the same rules you've been taught. They grow their money differently. They use leverage, they use tax-free growth, and not these slow compounders. They print wealth by controlling the flow of money. So the real question is, do you want to keep being this battery in the system, kind of like Neo in the Matrix, right? Or do you want to flip the script and build wealth like these institutions do. This is the foundation of the system, the formula they never wanted you to learn. This is the infinity wealth system. And so, just like I said earlier, it's built on 3 secrets that the wealthy use to escape the financial trap. And today, I'm going to show you how to use them. So, secret number 1, the tax-free retirement system you never knew. And this is how you beat the IRS. Most people think their 401k or IRA will take care of them in retirement. But here's the truth. These are tax-deferred tools. They're not tax-free. They're not tax deductions. You don't control when or how you can access your money. You'll be taxed on the full amount when you need it most. And by then, your tax bracket could be even higher than it is right now. And that's not freedom. That's a trap. Now imagine this instead. Your money grows tax-free. You can access it anytime without penalty, and you receive tax-free income for life during retirement. Your largest purchase is a house. Let me share you a tale of 2 houses that explains taxes and inflation. Part of the American dream is to buy a house, maybe even your dream house. This was my dream house before. This is in San Dimas, California. I used to live here. I moved to Texas. And so this is a $3.3 million home. It's 4 beds, 4.5 baths. It's about 4,500 square feet. And so to be able to buy the house, you're going to need $660,000 cash to be able to make the down payment. And this means in California, for you to earn $660,000 net, you have to make $1.1 million gross income to be able to save that $660,000, right? Net. The net looks a little gross, right? When you make $1.1 million and you end up just really keeping $660,000 after taxes. Again, that's the black hole of money at work. 80% financing at about 7% is going to end up at about $17,563 plus property tax, which is, let's just say 1% of 3.3 million is about $33,000 a year. And so the total cost per year is about $243,800 plus insurance. So you need to make $450,000 for that entire income just to go to mortgage, to make the payments for this house. Again, counting in about 12.3% state tax in California. It's crazy, right? And so this is the house we ended up buying, but this is $850,000. Down payment to be able to buy this house is about $170,000. And so you got to earn about $226,000 to be able to save this. And if 80% is going to be financed, that's going to be $4,545. Plus taxes, it's 2%, around 2% property tax in Texas. And so the total cost per year is about $75,000. And so you need to make, give or take, $100,000 to make $75,000 just to cover the mortgage as well. And you see the difference. You know, $100,000 versus $450,000. $100,000 gross income, $450,000 just going to the mortgage. So a house like this in San Dimas, California, probably only cost $850,000 25 years ago. Does that make sense? Just like how maybe a dozen eggs in a gallon of gas cost $1 25 years ago. Whereas a house like this in Wiley, if it grew by about 7% on average per year, is going to cost about $3.3 million 25 years from now. See how that works? That's inflation. And you see how you have to calculate after-tax dollars in your large purchases or your income in the future. So there's 3 ways you get taxed. Since we're going to be talking about future income, we're going to go through quite a bit of numbers. Just rewind the video if you need to hear it again. We need to start with the end in mind so we can reverse engineer how to build it. And so the first question is, when you retire, Would you like your retirement income taxed or not taxed? See, there's 3 ways you get taxed on your retirement accounts. We're using an example where it's for a married couple. And so I'm using rounded up numbers to make it easier to understand. If you're single, it's probably half the numbers. Income tax is at 22 to 24% at 100,000 to 400,000 household income. And these same tax brackets will apply to your retirement plan if you got a 401k, a 403b, an IRA, a pension plan, because this money is supposedly your earned income. You decided to defer the taxes. Again, like I said earlier, they are not tax deductions, they are tax deferrals. It's a trap in 3 ways. First trap, it doesn't grow as much. Maybe you're getting 6, 8, 10%. Seems a lot. But minus inflation, 6%, minus 4% inflation, that's really just 2%. And so this money is worth half or less in the future. The buying power of your 100,000 is only 50,000 in about 15 to 18 years because of these hyperinflations that sometimes happen in the market. So maybe even less. Maybe they're just going to be worth 30,000, 40,000. So if your lifestyle now costs 25,000, and this again in the future, 25,000 a month instead of $10,000 a month, you will need to withdraw about 500,000 from your 401k or receive that through your pension. And believe it or not, Social Security is taxed this way too. That's the second trap. The third trap is you can't use the money until you're 59 and a half years old, right? It's not liquid. And if you try to use it to pay off, let's just say your mortgage balance early, it will trigger this high income tax bracket upon withdrawal. So you can't use it for investment opportunity. You can't use it as an emergency fund, pay for kids' college, any of that stuff. And that's how this thing works. Now let me teach you how long-term capital gains taxes work. Long-term capital gains tax brackets is basically any investment that you hold for at least 1 year. And the tax bracket from 0 to 100,000 is 0%. And then it's 15% from 100,000 to about 600,000. And then 20% on anything over 600,000. And if you invest, let's just say in stock, cryptocurrency, real estate, as long as you don't sell that asset for at least a year, your returns will be classified as long-term capital gains. This means if you withdraw 200,000 from your portfolio during retirement, I'm just assuming this 100,000 at 0% tax bracket will increase every year and get to about 200,000 by the time you retire. So if you withdraw 200,000 or you liquidate your stock, then you're going to pay 0% in taxes on that withdrawal. Whereas if that 200,000 came from a 401k pension plan, it'll put you on a 22% tax bracket. And so you will have to pay 33,000 plus state taxes. And that's every year after year after year. And the last column is this tax-free column. 0% taxes on cash value inside a life insurance policy or a Roth IRA or a Roth 401k, regardless of the amount that you withdraw. So this becomes your tax-free retirement system. And this is not based on age. This is not based on your income or maybe the Roth IRA. And obviously it's not based on hoping taxes will be lower. It's never going to happen. So this is based on you having control, you having access, and then in long-term compounding all outside of the IRS grip. Except for the Roth, you can't touch the interest on that money until you're 59 and a half. So you need to reallocate your tax-deferred retirement accounts to tax-free withdrawals and build this tax-free nest egg. That's what we want to be able to teach you. So why the 401k, traditional IRAs, qualified plans, or IRA regulated retirement accounts is broken. The average 401k grows at about 6 to 8% per year before taxes. It's riddled with high fees, market volatility, tax traps, zero liquidity at age 59 and a half. You can't transfer that to your children. There is no generational wealth transfer, and it's 100% correlated to affecting you when you see these Wall Street crashes. It's never designed to replace your income. And so we show people exactly how their 401k will kind of fall short by hundreds of thousands or even millions. Not to just show them what to do instead. And so the next step, we want to make sure that your portfolio grows to beat inflation. And this will be on secret number 2 and 3. Let's go over secret number 2. How to become your own bank. How to beat the banks. So I'm going to share with you a tale of 2 cycles. Government borrowing and consumer borrowing. So this first cycle, government borrowing creates money at the top. This is how money enters the system. The US government needs money for the stimulus, for healthcare, for infrastructure, for wars. And so they issue these treasury bonds, these IOUs, sells them to the big banks and investors. And so the big banks, they buy these bonds, lending money to the government. And then the Federal Reserve buys the bonds from the banks. And where does the money come from? They print it. They print new digital dollars and give them to the banks. So now there's more money in the system. This newly created money becomes bank reserves. Banks now hold more cash ready to lend to the public. This is what causes inflation, the printing of money. And so on the second cycle, consumer borrowing multiplies money at the bottom. This is how money spreads through the population. Consumers go to the bank for loans, credit card, mortgages, car loans, business loans. This lending follows this fractional reserve system, which has a glitch because it creates this infinite money loop. So fractional reserve banking, otherwise known as the infinite money glitch, here's how it works. When someone deposits $1,000 in the bank does not hold on to all of that money. Instead, it only keeps 10% or $100 as reserves. And the remaining $900 is then loaned to other individuals or companies, with the bank charging interest on this loan and making additional profit. And so this person who receives this $900 loan then spends the money. And to simplify this scenario, let's just say the borrower immediately pays someone else $900. At this point, within the small financial system, there's now a total of $1,900 in circulation, even though the bank only has $100 in actual reserves. This is where this infinite money glitch begins, because the person who paid $900 then deposits the money into the bank and once again keeps 10% or $90 as reserves in the loans out the remaining $810. And then the person who receives the $810 spends it, and the money is now deposited into another bank. And this bank keeps the deposit, and on and on and on. And this cycle continues. And this ongoing process of monetary expansion is the infinite money glitch, creating this monetary multiplier effect. So now you understand fractional reserve. Banks create new money as a loan. The money doesn't exist before. It was digitally created. And so the consumer spends the loan. Just like I said, the money goes into someone else's bank account. the new deposit becomes another bank's asset. The bank's almost like working like a cartel, which can be loaned out again. This multiplies the money in the economy. Banks earn interest plus fees on every dollar they lend. So cycle 1 creates the money. Cycle 2 multiplies the money and traps the population in debt. And in both cycles, the bank win. They profit from both government debt and consumer debt. This is why you need the infinity wealth system. You need a system, not just a product, a system, because they run a system and you need to make that system work for you. So this infinity wealth system, it's gonna do a bunch of different stuff for you. Number one, it becomes your private family bank. And just like the traditional bank's fractional reserve system, you can make your money in a way kind of like do that too. You essentially create this dual wealth engine, which we'll cover on the third secret. You can borrow up to 90% of your cash to use it to make purchases or using this money to invest it. All the while, your cash remains the same balance and growing inside this family bank, right? This infinity bank. And so this is set up in a uniquely designed insurance policy, insurance contract. And so let me go over all the benefits that you can get with this infinity wealth system. You have protection. Just like I said, it's a life insurance contract. It has a tax-free death benefit payout in case you pass away. So it's going to take care of your family at the worst case scenario. But most of the time, people are not going to pass away. Less than 99% will pass away as you're building your wealth. Your money is also protected from creditors. You're protected from liens, from collections, from probate, and from the IRS. You have tax-free growth and withdrawals, and your cash grows without being taxed. As long as you follow the rules, and we're going to guide you with those rules. It can be designed to also have these healthcare benefits and pay you money in case you get cancer, heart attack, or a stroke. If you need to pay for long-term care, you have access to this death benefit, not just your cash, to use it for long-term care expenses. And again, it's protected from the IRS penalties and restrictions based on age. You can access it anytime, tax-free. You can borrow from the policy or withdraw, no penalties, no questions asked. And so here's the next benefit. Your money that's accumulating inside this policy is linked to the S&P 500 index. That if the market crashes, you don't lose a single penny. It features a floor and a cap. We're going to go over it later. So if the market goes down, you lose $0. That's the floor. But if the market goes up, you can earn the gains up to the cap, which can be 12%, 15%, 25%, depending on what the company offers. The same money can be leveraged while it's growing this way, and we'll show you how to create this dual wealth portfolio, this dual engine portfolio. You can create a fully diversified portfolio investments, whether it's stock, exchange traded funds, mutual funds, cryptocurrency, not inside a policy, outside of the policy, because of this leveraged system that you're gonna learn. We have a template called Financial Freedom 15, where you're able to copy the top 10 investments that people who control the stock market is buying and holding. These are the companies that most probably will control the future of AI. And speaking of AI, it can also forward project what is the best digital currency or cryptocurrency that is creating the foundation of digital transactions like Bitcoin, Ethereum, etc. You can also use it to buy real estate, especially if you want to build a portfolio of rental properties, because the cash value doesn't go down during market crashes. It's super ideal to have your investment capital in here so that during a market crash, when it's the best time to buy, your capital is rock solid and you are able to deploy your cash to make the purchases during the crash. And you can also negotiate better because you're liquid. And just like in what we said on the first secret, the way we designed this whole portfolio is to keep your income, your withdrawals in the future tax-free. The Infinity Wealth System is not just a wealth building system. It creates a growth mindset, an abundance mindset, a wealth creation mindset. It directs you the way you should think, to think in abundance. It covers both protecting your wealth, your health, and your family, but also creating a rapid acceleration of wealth accumulation. And this is the system that you, your family, and others need to learn to build. And we're here to guide you to do just that. So let's build this new economic engine and wealth accumulation ecosystem in your life. And so, last and final secret, third secret, is the dual wealth engine and how to copy the Wall Street titans. What if, as you save for retirement, you have these two buckets growing? Your policy and your portfolio. Let me just explain this as best as I can. If your policy, just like you're saving maybe $1,000 a month in your 401k, you're going to be saving similar in this policy, but it's going to come from after-tax dollars, not tax-deferred dollars, right? So let's just say you're able to save $1,000 a month or $12,000 a year. If the market grows by 15%, you're going to be credited 15%. So your $12,000 now becomes $13,800. And then let's just say year two, the same contribution of $12,000 you make, but the market does 20%, you're now going to get 20%. So your $13,800 plus $12,000 growing at 20%, now you have $30,960. And let's just say year three, the market only does 2%. And so you get 2%, you now have $43,000. Year four, however, the market crashes, negative 20. You don't lose money, but you just get nothing as credit that year. And so you're now at $55,819. Would be a good time to invest on these stocks that actually went down. And in year five, your $12,000, the market bounces, does 32%. And you will be capped, just like I said earlier, at 25% on this example. So you now have $84,774. So you grew $60,000 or $1,000 a month for the next 5 years, so about $84,774, right? Pretty good, zero risk, kind of like grew about 50% of your money. However, this is where the dual wealth engine works. Right around year three, about 24 months. Again, this has to be set up correctly. Using the system, you leverage the money. The $12,000 you put in can now be leveraged or borrowed. What that means is it's not a withdrawal, so it doesn't reduce the balance of your policy. There is going to be an interest that you have to pay, but let's just say this $12,000, you use it to buy NVIDIA stock. And at this time, around July 2000, it was about $16 per share. And so your $12,000 buys 750 shares. And then you do that again, and the next year, this $12,000, but the shares now is a bit more expensive, so you only end up buying 97. Your loans will increase. Let's just say it's about 5% every year as you take out money, and you can pay that off in cash or it's a tax write-off, or you can also have it accumulate and then pay it every 5 years. We're going to guide you how to do that. Let's just say the third year that you're doing this system, you take out this $12,000 again. Now you've taken out about $36,000. Nvidia shares is now $165 a share, so you only were able to buy 72. And now the total share you've owned is 919 shares. And the current value, 1919 shares at 165 per share, is now 151,000. And again, as that price grows, it will fluctuate, but again, you're not selling it, you're just accumulating it. You have 84,000 here and 151,000 here. You have to understand that there is an outstanding loan. This 36,000 will either need to be paid if you're alive, or it's going to be deducted from the life insurance death benefit if you die. Okay? So the life insurance is the collateral for these loans. Does that make sense? And that's why essentially you're kind of like using it while you're still alive. I thought that's pretty good. And that's where you can grow that. So most people, the next question they ask is, how do I know where to invest? And that's the strategy that you will learn. But what if there was a way to copy the investments of the largest companies that control Wall Street? What if you have a copy-paste portfolio where you don't have to do the guesswork of what stocks to buy, but instead copy the titans of Wall Street? So these are the 4 companies that control over $32 trillion combined. And here's the wild part. They all own the same stocks. Apple, Microsoft, Google, Amazon, Meta, or Facebook, Nvidia, and Tesla. This is what's called the Magnificent Seven. They control 2/3 of Wall Street. And if the same 4 firms, BlackRock, they manage about 11.5 trillion with a T, 10.5 trillion for Vanguard, 5.5 trillion for Fidelity, and 5 trillion for State Street. If the same firms who control 2/3 of Wall Street are all betting on the same companies, that's not a coincidence. That's pure coordination. They have the power to influence markets, unfortunately trigger crashes or inflate bubbles, and they don't just play the game. It's in a way rigged to their favor. But here's the good news. Every quarter by law, they must disclose their exact holdings through something called a 13F filing. And once you understand, it's very simple, very straightforward, and that's something that we can teach you. You can mirror their moves, again, copy paste, and start building your portfolio the same way they're building theirs. And this now gives you certainty how to build long-term wealth by owning the same winning companies that they do. Because if you could legally see the most powerful players in Wall Street, what they're buying, what would you do with that information? And that's what you're going to get. Again, just like I said, this is not a product. This is a system, the Infinity Wealth System. It will teach you how to beat the IRS, create tax-free income for the rest of your life. This is also how you become your own banker. And this is how you outsmart Wall Street. So you've got 2 paths in front of you. Option 1, you can work with our team that's built the roadmap, refine the system, and is actively helping families grow tax-free wealth. Book a free call. It's on our link below, and we'll go meet you on Zoom. Option 2, you can do it alone. You piece this together and get generic advice that was never designed for your life and your goals. Listen, I tried the do-it-yourself route, right? I read the books, watched the gurus, but nothing truly changed until I found someone and had a team. And now the same system that we're offering to you to not just learn about wealth, but build it. Build it based on the strategies of the people who also built it. So here's the next move. Click on the link, book the free Zoom call. You'll get about 45 minutes with someone from our team to help map out your next play. Zero pressure. But if you pass on this, just know you're choosing the hard road. No guide, no system, no leverage. So if what you saw today makes sense, then don't wait. Take the next step. Most people never get a chance to sit down with someone who actually shows them how to design their financial future. This is your moment. I'm excited to meet you. My name's AG. I'm the Wealth Architect. I look forward to helping you design your future and really help you fast forward financial freedom. Let's build it together. I'll see you on the other side. Take care. God bless.